Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA N. Raja, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice. Had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executive. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar. Here, I need your participation. Look at this, there is a company which has made or achieved a sales of 100 crore by incurring expenses of 60 crore and reporting profit of 40 crores. So now I have a question for you. The question is, what is the cash generated by this business? Sales is 100, expenses are 60, profit is 40. So what is the cash generated by this business? The cash generation can be equal to profit when they have realized their entire sales of 100 crore and met their or paid their entire expenses of 60 crore. It means 100 crore had come in and 60 crore had gone out. So the profit will be equal to cash. But it can also be greater than 40 crore. It can also be less than 40 crore. It can be greater than 40 crore when you have realized the entire sales and you have paid only part of the expenses. So here you have cash as 70 crore. And it can be less than 40 crore when you have realized only the part of the sales and you have paid full expenses, okay, or most of the expenses. So you have realized only 70 crore but you have paid entire 60 crore. So here your cash is only 10 crore, okay. And this can also undergo a change. This cash of 70 crore can come below 40 crore. It can even come below, it can come below 70 crore. It can even come below 40 crore. And this cash of 10 crore can go above 10 crore. It can even go above 40 crore. How? Let's say a loan has been repaid 40 crore. Some machinery has been purchased for 20 crore. It means out of 60 crore gone. So what is the cash position? It is now only 10 crore. And in the second scenario, let's say a debenture has been raised, money has come in for 30 crore. Some asset has been sold, 20 crore money had come in. Equity, money had come in from owners, 20 crore. So we have 70 crore money coming in. So now the total position is 80 crore. So what we have to understand is, in business, cash is not generated merely by profit. It is from various activities. We call them as cash flows from operating activity, cash flows from investment activity, and cash flows from financing activity. Look at this 70 crore. This is a cash flow from operations, operating activity. Whereas this 40 crore repaid is a result of financing activity. They raised finance in the past. They are repaying that now, financing activity. Look at this machinery purchase 20 crore. They are investing their money. It's an investment activity. Whereas this debenture of 30 crore money coming in is a result of financing activity. And they have sold assets 20 crore. They are disposing of their investments is a result of investment activity. Whereas this equity 20 crore which had come in is a result of financing activity. And finally the 10 crore cash is a result of operating activity. So what we can infer is, in business, cash can come in and go out under 3 activities: operating activity, investment activity, and financing activity. So in a year, if you capture all this, cash flows from operating, investment, and financing activity, and if you total them, you get to know what is the cash generated during the year. And with this, if you add the opening cash and equivalents, automatically you will get the closing cash position, closing cash and cash equivalents position. And this is something known as abridged cash flow statement. So what's happening here? I'm capturing the cash flows from operating activity, investment activity, financing activity. I'm aggregating them so that I can get the cash generated during the year. And with this, when I add the opening cash balance, automatically I get the closing cash balance. Okay. So this statement, by having a look at this statement, I'll get to know from where money had come and where money had gone out. Okay. And it also acts as a reconciliation statement, because by adding the cash generated during the year with the opening balance, I get the closing balance. Let me show you a real life cash flow statement. It will look something like this, with many line items and subline items. But being part of bank executive, being part of bank, your focus should be on how to read the cash flow statement, because the preparation of cash flow statements are taken care by accountants. So you should know where you have to keep your eyes. Okay, look at this cash flow from operating activity. It's a positive figure of 4,60,600. Look at this investment activity. It is a negative figure of 1,75,000. So the positive figure of 4,60,600 from operating activity means they've run their business for one full year, and from operations they've made a positive cash. Whereas investment activity negative figure means they have paid 1,75,000. Cash had gone out to the extent of 1,75,000 because they have made some investments. So some other assets have come in. So if you want to know what are those assets, you have to go back to the statement. Look, they have purchased plant and machinery. They have purchased some investments. Then look at the next key item, that is investment activity. Financing activity. The next key item is financing activity. And it is a negative cash of 2,70,000. It means to that extent cash had gone out. And if you want to know what are those components, you can go to the cash flow statement and you can see. And now if you add all the three, you get to know what is the cash generated during the year. And it's 15,600. So when I look at this, what I infer is they made 4,60,600 from their operations, and they use their own money for making some investments. And despite spending on investment, they had so much of money, so they are very easily settling their financial obligations. And despite all this, they still have positive cash of 15,600. And here we need not worry because they made so much of money, but everything has gone out. We need not worry because look at their opening cash and cash equivalent position. They already had 1,50,000. So this 1,50,000 plus what they've made during the year, if you add, still at the end of the year, their position is really comfortable. It's actually better than the previous year. Previous year it was 1,50,000, and at the end of the current year it is 1,65,600. So when I look at the cash flow statement, things are looking too good. But you should also be very cautious, because sometimes businesses will be showing good amount of profits, but cash flows from operating activity will be negative. It's because most of their sales are logged with the customers, or most of the money is logged in the inventories. So because of that, cash flows are not happening, so they'll be struggling. So for a healthy business, what is required is a positive cash flow from operating activity. Look at their investment activities. Is it positive or negative? Positive means they are disposing of their investments. They are getting some money out of investments. If they are disposing of their investments, if they are selling their investments, what assets are they selling? Are they selling the core assets or non-core assets? If they are selling the core assets, then the question of going concern will arise. Because by selling their core assets, how they will continue their operations in future? Or if they are selling their non-core assets, it's a good strategy, because they are infusing liquidity into the business by disposing of the assets which are not required for running the show. Look at their financing activity. If it is a positive figure, it means money had come into the business. From whom that money had come? Is it from owners? Is it from outsiders? What are the terms? All those can be explored and it can be understood. So these kind of critical information are possible by going through cash flow statement. Okay. So we know cash flow statement is a statement which is going to list out the cash flows as per activities. And activities are divided into three. They are cash flows from operations activity, operational activities, cash flows from investment activity, cash flows from financing activity. Okay. So all the three put together will give what is the net increase in cash and cash equivalent during the year, and with that, if you add opening cash and cash equivalents, you will land in closing cash and cash equivalents. Okay. So this is the abridged form of a cash flow statement. The general cash flow statement, what is attached or what is part of financial statements, will be a detailed and elaborate one. What we are seeing here is the abridged form, and this is what will go into the loan proposals, because sanctioning authority or people who are sitting in the sanctioning board are interested in knowing the gross movement, not the minute movement. Okay, let's have a look at this cash flow. We have cash flow of, let's say, X Limited for the previous 2 years and estimate for the current year. So what is happening in previous year 2? Let's analyze that. Net cash from operations is negative 1.31. Let's say figures are in crores. It is negative 1.31. It means the cash what they have generated from operations is negative. When we say operations, it is the cash which they have generated from sales minus cash what they have incurred on their operational expenses. And eventually, if they look back, they have not generated any cash. They have actually used cash in their operations. They are running business. The very objective of running business is to make money. But when they look back at the operations, they have not made positive cash. They have made negative cash. Okay, and it is bound to happen, especially in new companies, because in the initial stages they'll be suffering losses, then they will reach their break-even point, and only after that they'll start making profits. Okay, so those companies will be having negative cash flows from operations. Number 1. Number 2, the companies which have substantial investment in working capital assets, they will also have negative cash flow from operations. Let's say, for example, sales made by the company is 100 crore. Expenses incurred by the company is 90 crore. Profit what they have made is 10 crore. But if you look at their cash flow position, you will conclude or you will see that they have not generated cash of 100 crore. Why? The reason can be like this. Out of 100 crore sales, let's say 70 crore is on credit. It means they have generated cash of only 30 crore. Out of 90 crore expenses, they have already paid, let's say they have already paid 60 crore. Okay, it means what is yet to be paid is only balance 30 crore. But you have to see these two. This is the cash which had come in, and this is the cash which had gone out. So the cash that came in was 30 crore. The cash that went out was 60 crore. So what they have made from operations, they have actually ended up in paying 30 crore without generating any money. So from where they paid this 30 crore, that's what you will get to know from cash flow statement. So please have a look at this once again. This is the sales. These are all the expenses. This is the profit, right? Out of sales of 100 crore, they have sold 70 crore on credit. It means cash realized or cash sales is only 30 crore. Assuming the 70 crore is still debtors, it means not yet realized. Out of 90 crore, they have already paid 60 crore, 30 crore not yet paid, assuming it is still unpaid, sitting as creditors. So you can see the cash that had come into the system is 30 crore, cash that had gone out of the system is 60 crore, and all these are operational cash flows. So if you look at their net cash flows generated from operation, they have actually paid 30 crore more. So from where they got the money? They got money either from cash flows under investment activity or cash flows under financing activity. Okay, so those kind of questions and all will get answered when you analyze the cash flow statement. Now in this case, your sanctioning authority will be worried with this figure. Okay, so in previous year 2, in their operation they had outflow of 1.31 crore. It is not only in operations, under investment also they had 2.39 crore outflow. So negative cash under investment activity indicates there is an outflow, let's say for purchase of fixed assets. It can also be making some investments in group concerns also. So you should not conclude that this negative figure under investment activity is only for purchase of fixed asset. When this figure is very big, you have to go behind this, you have to look into the schedules. So here also there is an outflow, here also there is an outflow. From where they got money for all these outflows? 1.31 crore plus 2.39 crore, totally 3.7 crore. From where they got money for all this? They got money for all this from financing activity. Financing activity, they have mobilized 3.7 crore. So we can understand that they have mobilized 3.7 crore, and that is used for funding investment, and that is also used for taking care of the negative cash flows under operations. So now the question is, what is the breakup of this 3.7 crore? If it is fully from equity, it is good. It means owners are investing money for their investments and they are also taking care of the losses suffered. Or is it fully by loan? Then it is a matter of concern, because there is a substantial operational negative cash flows and they are also investing, and owners are not participating, everything is getting funded by loan. So you have to look into this, from where they got this 3.7 crore, and it can also be a mix. It can also be a mix of debt and equity, and if the overall TOL by TNW is satisfactory, then the mix is also okay. The mix is also okay. So all those got to be studied. So here there is a negative operational cash flow, there is a negative cash flow under investment activity, and all were funded from financing activity. And if you sum all this, net increase in cash and cash equivalent is 0. They didn't have any opening balance and they're also not having any closing balance. This is previous year 2 analysis. Let us also analyze previous year 1 now. We'll do the analysis of previous year 1. Previous year 1, their negative cash flow from operational activity increased. Previous year 2 it was 1.31 crore, but now it increased to 4.56 crore negative cash flow. And if you look at the cash flow from investment activity, negative cash flow previous year was 2.39 and in this year it has come down. Okay, so now this is going to raise serious concern for the sanctioning authority, because negative cash flow is increasing year on year. It is increasing year on year. This indicates either this negative cash flow is on account of loss, or this is on account of poor working capital management. This is on account of poor working capital management. So sanctioning authority will be interested in knowing what is the reason why there are negative cash flows, and is it because of substantial money getting locked in working capital assets, inventories, debtors, whether steps have been taken, because ideally, or for that matter any business, they should generate positive cash flows from operational activities. Okay, negative cash flow from operational activities is not a good sign. Just think of a scenario where you are running a business, and if you want to sustain, if you want to manage that business, you are always dependent on either bank funds or additional infusion of funds from the owners. That's not a good sign, right? Your business should be able to stand on its own, and that is possible only when it has positive cash flows. Some negative cash flows are fine, but that can be managed, okay, but not year on year increase in negative cash flows. Then it indicates something have to be really looked into. So this have to be studied, and the reasons for increase, okay, what are the components of this negative cash flow, all those have to be elaborated in the loan proposal. And in this year also they are going for some additions. So this have to be seen, whether is it fixed asset addition or is it any additional investment in group concerns. What is the need for creating these additions, especially when they have negative cash flow year on year. So that should be studied and elaborated in the proposal. Then, so they have negative cash flows in these two areas, and how they got funds for all this? They got funds through financing activity. It means they have mobilized funds. So this 5.71 crore should be studied. How much had come from equity? How much had come from debt? So what is the proportion? Whether TOL by TNW is satisfactory, because year on year they are reporting negative operational cash flows, and they are managing the show only with the funds what they are mobilizing through financing activity and not on their own. So this got to be explained. So here these two outflows were managed by this inflow. After setting of this, there is a surplus of 0.26 lakhs, okay, 0.26 crore, and that is available as closing balance. Fine. Then what they are estimating, we'll see that as well. For the next year, they are estimating net cash from operational activity negative 8.43 crore. So what is estimated itself is negative. So it is possible that this can be accepted by sanctioning authority also, because there are some business models which will have high working capital cycle. Okay, it may be in the range of 180 to 200 days. The margin, profit making capacities of those business will be very thin. They have to substantially invest in inventory and debtors. So they may be making good amount of sales, but substantial portion of that will be logged in the debtors, and because of that reason they will have negative cash flows under operations, which will get funded under financing activity in the form of a CC. So if cash credit is shown here, okay, where we'll capture it under financing activity, then this position may be acceptable. Okay, because this cash credit facility comes into picture to support working capital cycle only. So had this cash credit been adjusted here, then the negative figure may not be so much, or it can even turn out to be a positive figure. Okay, so just think of a scenario. Let's say sales is 100, expenses are 90. This is actual. Okay, let's look at the cash flow also. Out of 100, what is realized is only 30. Out of 90, what is paid is, let's say, 50. So there is a negative cash flow of 20, and if this 20 is funded by CC, let's say CC available 20, then end of it, if you look at the operational cash flows, it will be 0, because we had negative 20 that was funded by plus 20. If this 20 is captured under operational cash flows itself, okay, as part of current liability, this will become 0. Instead, if the 20 is captured under financing activity, because cash credit is a financing activity, then it will show difference. Okay, so in that angle, this negative cash flow can also be tolerated, but this should be the reason. Otherwise, it cannot be accepted. Okay, let's continue. So here they are estimating this, but it can be accepted only for the discussed reasons, and there is some small investment, estimated investment in investment activity, that is fine. This 10.47 crore have to be analyzed, because they are estimating almost double the level of previous year financing activity. So what are the sources? How much is coming from equity? How much is coming from bank financing? How much coming from other loans? Okay, so all those got to be listed out here, and eventually if you total this, they will have 2.04 crore cash generated during the year. With that, if this opening balance is added, closing will be 2.3. Now this is only an estimate, it may or may not happen, but it should be as much as realistic as possible. But these two are actuals, and the reasons for say the deviations or higher levels, all those got to be explained. Sorry for that. Okay, So this is how we typically analyze cash flow statement in loan proposals. Thank you so much. We have come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. It is this Credit and Financial Analysis Mastery course, exclusively designed for bankers and for those who want to have bankers' point of view. This is a course which we have developed after a detailed analysis, a thorough discussion with several hundreds of bankers and finance professionals. We have identified what is their exact requirement when it comes to SME and corporate credit and financial analysis. In this mastery bundle, I'm going to give you access to various courses. To start with, we have course number 1, Basics of Credit Analysis. In this course, we have explained the basics of credit analysis through various sections, section 1 to 9. Next comes course number 2, that is how to read balance sheet. In this course, we have explained what is balance sheet, how to read them, how to approach them by using real life financial statements. Then comes course number 3, how to do financial ratio analysis like a banker. In this course, we have explained all critical ratios that are analyzed by the bankers, and we have also explained through case studies. Then we have course number 4, how to do cash flow analysis. So through this course you will understand what is cash flow analysis, how to do a typical cash flow analysis. We have used case studies, and reference to Ind AS is also included in this course. Then we have course number 5, that is how to do fund flow analysis. This is a critical financial analysis tool, and in this course you will learn what is fund flow statement, how to analyze them from banker's angle, how to prepare fund flow statement from academic angle as well. So overall 5 courses, each 1499. So aggregate price should be 7495, but you are not going to pay that. For you, it's just rupees 2499 for 1 year access, or rupees 4999 for lifetime access. And it is not yet over. You have some more bonus. Bonus is course number 6, how to carry out credit risk rating for non-trading entities. These are all the topics covered in this course. Then course number 7, it is how to carry out credit risk rating for trading entities. Not yet over. You also have access to course number 8, that is how to prepare CMA report for bank loans. It's a comprehensive course which will run for 8 plus 5 hours, and you will learn entire CMA report preparation process. And course number 9, how to prepare cash budget for bank loans. Course number 10, how to assess fund-based working capital. So in this course you will understand what is working capital, what are working capital credit facilities, and how to assess them, what are the key ratios that are related to working capital, and what are the additional key analysis that will be done by bankers on working capital matters. You will get a comprehensive understanding of cash credit, export finance, and there are certain on-demand videos as well. So 5 plus 5, 10 courses of value close to 15,000 rupees, but you are going to get it for 1 year access rupees 2499, lifetime access rupees 4999. Not yet over. You are going to get access to the 11th course, how to assess non-fund based credit facility. So in this course you will learn about letter of credit, bank guarantee, its assessment as well. Then comes course number 12, how to do term loan appraisal and assessment, because it's a complex process with a lot many technicalities. So this course covers all in detail. And course number 13, basic elements of loan proposal. So how a typical loan proposal will be, what are the basic elements that are covered in this course. And we have course number 14, case study on credit analysis. Various case studies based on practical experience and discussion with various bankers and finance professionals are included in this course. And course number 15, this is about collateral securities, where you get knowledge about collateral securities. So overall it's 15 courses of value close to 22,485. It's 1,000 plus lectures. You can subscribe for 1 year access or lifetime access as you wish. These are all pre-recorded courses, so you can access them anytime as per your convenience. You can access them in mobile app or desktop, and for you the price is not 22,485, it is rather 2,499 for 1 year access or 4,999 for lifetime access. You can check the link in description, where without using any discount coupon code you can enroll at this discounted price, because it's a discount applied link. and not yet over, you are also eligible for some more bonus. The bonus is access to various ebooks and e-resources. You are going to get access to various financial ratios ebooks, financial management related ebooks. You will get access to financial analysis related ebooks, credit analysis ebooks. Not yet over, you will also get access to other resources like test series, templates, audiobooks, video books, career guidance material, and a bonus resource. Check the link in description and enroll now.